Hello everyone! In this video, I'll explain how US tax brackets work. Taxes might seem complicated at first, but with the right explanation, it all becomes much clearer. In this video, we'll break it down step by step so you can understand what tax brackets are, how they affect your income, and why they matter. Let's start with the basics. In the United States, individuals and households pay income tax on the money they earn. This includes wages, salaries, investments, and even things like side gigs or rental income. The federal government, along with most states, collects income taxes to fund things like infrastructure, healthcare, and education. The US tax system is progressive. That means the more money you earn, the higher the percentage of tax you're required to pay on certain portions of your income. This is where tax brackets come into play. Each bracket has a specific rate, and only the income that falls within that bracket is taxed at that rate. Here's an example to make it easier to understand. Let's say you're filing your taxes as a single person in 2024 and you earn $50,000. The first portion of your income, up to $11,600, falls into the 10% tax bracket. This means you'll pay 10% of that $11,600 in taxes. The next portion of your income, from $11, $60 up to $47,150, falls into the 12% bracket. You'll pay 12% on that segment of your income. Finally, the portion of your income between $47,150 and $100,525 falls into the 22% bracket, and you'll pay 22% on that portion. It's important to note that not all of your income is taxed at the highest rate. Instead, each portion is taxed at the rate for its specific bracket. This is what we mean by marginal tax rates. If someone earns $135,000 in income, their federal income tax can be calculated by applying the tax rates across different brackets. For the 2024 tax year, the income is taxed progressively across several brackets. First, the income within the lowest bracket, up to $11,000, is taxed at 10%, resulting in $1,100 in tax. The next portion of income between $11,001 and $44,725 is taxed at 12%, which amounts to $4,047. Then, the income between $44,726 and $95,375 is taxed at 22%, resulting in $11,143. Finally, the portion of income between $95,376 and $135,000 is taxed at 24%, which amounts to $9,510. Adding up the taxes from each bracket, the total federal tax liability would be $25,800, assuming no other deductions or credits apply. This method ensures that only the income within each bracket is taxed at the corresponding rate, with the highest tax rate applying only to the portion of income in that range. Now, let's talk about deductions and credits, which can lower the amount of income tax you owe. A deduction reduces your taxable income. For example, the standard deduction is a fixed amount you can subtract from your total income, which reduces the portion of your income that's taxed. In 2024, the standard deduction for a single filer is $24,800. On the other hand, tax credits directly reduce the amount of tax you owe. A good example is the Earned Income Tax Credit, which benefits low to moderate income workers. Another is the Child Tax Credit, which helps families with children. Unlike deductions, which lower your income, credits are subtracted directly from your tax bill, which can make a significant difference. It's also worth noting that not everyone pays federal income tax. Some people, especially those with lower incomes or specific life circumstances, can qualify for enough credits and deductions to reduce their tax liability to zero. However, higher income earners contribute a larger share of federal income tax revenue because of the progressive structure. Individual income taxes make up a significant part of government revenue. In fact, they account for over 40% of the federal government's income, making them the largest single source of funding. This money is used to pay for programs and services that benefit society as a whole, including national defense, public health initiatives, and social security. State income taxes work a little differently. Most states also collect income tax, but the rules vary. Some states have flat tax systems where everyone pays the same rate regardless of income. Others use progressive tax systems similar to the federal model. And there are 7 states, like Texas and Florida, that don't collect income taxes at all. To sum it all up, the US tax system is designed to adjust based on how much money you make, with the goal of making taxes fairer. While the system might seem complex at first, understanding how tax brackets work can help you see how much you'll owe and why. Deductions and credits can also play a big role in reducing your tax bill, so it's worth taking the time to learn about them. Thanks for watching. If you found this explanation helpful, feel free to share it with others who might be curious about how taxes work. Remember, understanding your taxes isn't just about numbers. It's about empowering yourself to make informed decisions.